I'll let you know when it tells us.
I already got the message on this side.
We are live. All right, so for those of you who are joining us from YouTube, I just wanted to get on here and before Jay starts and just thank everybody sincerely for all of the donations that we received for Harvesters and Sport Trust for the Zimbabwe project. We were able to receive so much money that we actually made a direct transfer to get the farm up and going right away. So we sent the first tranche of $2,000 to Prosper. And then we were continuing to receive donations. We received another $5,000 or just over $5,000. And then we've continued to receive funds going forward. But because I did say that we were going to have the raffle and that I would announce the winner on Tuesday, we did postpone it a couple of days because people were still, those donations were still coming in. But so we have now had the raffle and we have drawn 3 people for our for our prize. It's just a thank you gift from the Trade Speakeasy. And we are really thankful, actually, the artist, Fabian Defay, who did the Decolonize Wealth project with us back in Juneteenth. He had saved on the side a number of sets of the limited edition prints that are stamped and signed. And so he has given us 3 sets to be able to give away to the winners. And so one of the winners is from the EYL Houston group, and that is Rich Prince. And then there is a lady from the Stock Entertainment group with Coach Larry, and that is a lady who likes to go by the name Lala. So I don't know if she would like me to use her full name, but she knows who she is. And for our final and 3rd winner, it actually is one of the people up on the screen, and it is Greg, so who is part of our Trade Speakeasy. So it was nice how it worked out because it seems we got a bit of representation from each of the groups, but it was just totally random. So thank you guys so much for the donations to the Zimbabwe project. The team on the ground was just so elated. They weren't expecting it because, we really did pitch this as just a time to share about what's going on the ground in Zimbabwe and to talk about inflation and some of those macro dynamics. So it was just a huge blessing for them to actually be able for us to actually respond to what they shared, because leading up to the conversation, we hadn't realized that they had postponed planting during this season and that they were coming so close to the rainy season. So that was good on you, Greg, for pulling out that data from Prosper. So I just wanted to get on here and again, thank everyone for their amazing donations to the project. And we will continue to give you updates as the farm is moving forward and relating to the feeding project. So I am going to sign off now, and it is to you, Jay.
All right, Suzanne, thanks a lot.
Thank you.
And just on that note, I just feel so proud to be a part of this community. Just to thank you to everyone who donated, everyone who took the time to watch that video, and just understand the way that inflation is affecting people that we don't know. And so we're all here trying to figure out how can we best support our families and how can we become better traders to create a better vision for our families. And the fact that this community is so unique because we think about people that we don't even know. And we want to try to make the world a better place. Just makes me so proud. So really, like I said on Telegram, it does inspire me to just do better. I want to be the best trader I can be so that I can help as many people as I can help. And just having such an incredible leader like Suzanne, who can put so much information in front of us, not only the information of how to trade the macros, how to look into the option chain, which is a really micro detailed thing, but then also what are the real world tangible effects? And then what is our responsibility in challenging ourselves to look in the mirror and decide what does that responsibility mean for every single one of us. So to everybody in our community, just really thank you. Suzanne, thank you so much.
Thank you. That's so kind of you, Jay. And I love you guys so much. I love our community and what we've been building and building towards. And I'm really excited to just continue to see how we continue to expand and explore our, not only our own personal genius in our trading, but also our ability to pass that on to other communities in our own unique way. So thank you, Jay. And I look forward to watching you on YouTube.
Thanks. All right, so let's jump into it for today. Today's class, we're going to be covering the long calls. I'm sorry, no, we're not. We're going to be covering short puts. Still bullish, but not the same thing. We're going to do things a little bit different. Today's class is going to assume that you've been caught up with the curriculum so far this round. We are going to be dealing with credit spreads eventually today, and also how with credit spreads, just the idea of iron condors, what an iron condor is, and how to leg into an iron condor. But don't worry, if you missed us on credit spreads last week, I will explain this in a way that'll make sense, okay? Before we get into that, the disclaimer, we all have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. When we talk about short positions, that is that place where if we're not careful about the way that we actively manage our position, then it can get away from us. This page is super important. I think last week I harped on it a lot, and I'm not going to harp so much. I'm just going to talk about this. This is a slide from last week, and then we're going to look at my think or swim to kind of see how some of these short calls, had we taken them last week, would have worked out. Spoiler alert, if you weren't watching the market, they wouldn't be doing so well right now. But the good news is, if you were watching the call last week, I was not saying to take them. So by no means am I ever giving trade recommendations on here, but I also was definitely not giving trade there, just to make that clear. This was last week's slide just before the call started. And we were actually comparing various call contracts, all the 20 delta. So all calls, the 20 delta means two things right off the bat. It's going to be affected by $1 change in the underlying by 20 cents against the option contract. So that's what that 20 delta is going to tell us, whether it's a short call, long call, whatever it is, whatever side we put it on, or a put. If we sell the 20 put, then every dollar that the underlying moves is going to change by 20 cents until Gamma gets a hold of it and takes it in another direction. But it's also telling us a probability. A 20 delta is telling us that there is a 20% chance based on the calculations of the option chain. So it's a theoretical probability, but it's a theoretical 20% probability, not based on any technical analysis, just based on how the option chain is trading at the moment that you look at it. it's telling us that it has a 20% chance of expiring in the money. When you're selling, it's nice to kind of give yourself a cushion by saying, you know what, some contracts might still have value, but they don't have a great probability of expiring in the money. That being said, let's look at this first 7 DTE contract that we talked about hypothetically last week, selling for $1.38 credit. So that's, 138 regular dollars. And see if I can pull up my Thinkorswim. And for those of y'all who can see, like Greg, can you give me a nod? Can you all see my Thinkorswim now?
Not yet.
Oh, you're not seeing Thinkorswim?
No, I just see your screen.
Okay, then I'm gonna reshare.
The chart that you had up was what I saw.
Got it. Let me jump into, how about now?
I still see the chart.
It should look very similar.
This is Thinkorswim.
Yeah,
Good. Okay, cool. Good.
Okay.
Good. Okay, great. This is the same chart, but it's updated.
Got it. Okay.
This is right. So here's that call.
Oh, wow.
That would have expired. Sorry, this shouldn't say 7 DTE. This one would have expired. So this one actually would have expired in the money. That would have been a loss. All right. I'm actually going to try to do this more smoothly. Just bear with me for 1 second.
But you were
should be able to
you were selling a call there, just for confirmation?
We were not. Let me be clear. We were theoretically comparing the cost of various contracts on the option chain. And so right now, this is just sort of a review from last week.
Okay.
Had we been selling,
you had a credit there, so I thought it was because you were selling.
I'm sorry. Let me just be clear. Theoretically, we were selling. I just want to make it clear that in actuality, we were not selling. So
got it.
Okay. So, and now what I'd like to be able to do is quickly, do we see the original slide now?
Yes.
Great. Okay. This is what we looked at before. And so remember, I drew this box sort of around a generic weekly range, compared it and said, hey, be careful. If we have a bullish week, these positions are going to be threatened. So this obviously was the first position to be threatened. It would not have panned out for us. And so the point that I'm trying to make is, just because an option says that it has a 20 delta, and that's giving us a theoretical 20% chance of expiring out of the money, which is what you want if you're selling, just because the option chain says that, it doesn't mean that this time it's going to work for you. And so that's why we have to build in risk management. And so I do think there's a pretty cool section on risk management where I kind of build a case for how to manage the risk of options. And we will get into that when we talk into our put discussion. But it's just important to understand that just because we have this delta that says, the probabilities are in my favor, it doesn't mean that the particular time that you enter the trade, the probabilities are going to work out for you. So I just want to always make that super clear. We're jumping back into now the actual Thinkorswim. Notice that had you sold more time in these theoretical positions, you'd have some heat on this trade with 14 days left until expiration, and you would still be looking at a loss, I would venture to say. But let's go into the option chain now to see if that's the case. So notice when you sold it with 21 days, theoretically, it had $2.58 credit, and that's the 390 strike at now updated 14 days till expiration. Let's just look at what that's trading at now. It might actually be okay now that price is backed off, but imagine what you're feeling when price is up here threatening you. I think I did my math wrong, so apologies. And to the chart, we said it's the 390. you'd actually still be looking at a small loss right now. So you sold it for 258. And right now, the 390 is selling for 275. So you'd be basically right back where you started, with probably yesterday a high degree of stress, and then going into not knowing how well Amazon or Apple would do on earnings. Yesterday, it would have been a hard position to manage. And so I think I kind of made the point now about still have to have a good understanding of what's going on technically when you sell these, if you want to have a trade that's beneficial and easy. To me, I like the idea of taking a portion of my trading account and selling either calls or puts, or sometimes both if it's an iron condor, but doing so in a way that feels like really easy money, not in a way where I sell it willy-nilly and then all of a sudden price is like screaming against me. And so today's call is going to be, yes, on the theory of how to sell puts, but also I'm always going to go back to the practical of, hey, if we're in a chart and we're trying to figure out how to make this an easy trade, then we still want delta to be on our side. Theta is going to eat away at the premium of the contract only so much if delta is screaming against us. So I'm not going to go into the rest of these strikes, but I think it makes the point that, had we sold last week, it wouldn't have been a good time to sell. And in fact, we wouldn't really be seeing any benefit from doing so because price is still going against us. All right. With that said, we're still going to revisit short calls, but now we're going to kind of take our detour back into the original purpose, which is talking about short puts. So with that, short puts, the purpose: act as the seller, collect credit with the aim of price being above your strike at expiration. So short puts, really the same idea as short calls. When you're selling them, generally, you want them to expire out of the money, and it's a premium collection type of a trade. The only difference is when you're selling calls, that's a bearish idea. When you're selling puts, that's a bullish idea. To sell a put with the aim of price making a bullish move away from your position efficiently and rapidly. So just like we were talking about with the calls, if we don't have a good reason to think that price is going to move away from us, it can be a stressful thing to manage. So market landscape, you want to expect a flat to bullish movement in the price of the underlying, or you aim to benefit from time decay, as long as price of the underlying remains above the short strike. You aim to benefit from the change in delta from a strong bullish move in the underlying. So short put, you act as the seller. You are paid for a contract that you will buy 100 shares at the promised price. Your expectation is that the price will remain high. So the buyer of your contract will make more selling on the open market than selling at your agreed price. Long puts is to act as the buyer. You pay for a contract that secures your sell price. Your expectation is that prices will drop and you'll secure the benefit in the higher sell of the price contracted. So the idea again is just to make sure a put can be used long or short. We've already talked in the curriculum about a long put, and this is where, if you're coming into trading directly from trading stocks, the terminology can get a little bit tricky, because if I'm long a stock, I'm bullish. Well, if I'm long a put, I'm bearish, because I buy a put to capitalize on price going down. So just try to make sure that that is clear in your mind. If I'm short a put, I'm bullish because I want price to expire above that put. And here's the profit and loss scenario. you can see always the slider goes from lower price to higher price. And then we go from break even to profitability to a loss. If price moves away from the strike that we sell, we keep our premium. As price violates, we can continue to lose money against us for every penny that price is trading beneath our strike. When we at expiration, we're going to be responsible for the difference. All we get to collect is the premium. So we have that premium no matter what, but that premium comes with the risk. If the put expires lower and lower beneath the strike that we sold, then we are going to owe the difference between where we sold that strike and where price is actually trading currently. So strategy for entry and exit. You want to sell to open. And so that selling should mean that charting demonstrated that price will remain above the strike price you selected. Technical analysis demonstrates there's likely a strong bullish move in the underlying. Volatility is high and likely to drop in the near future. One of the nice things about selling puts is volatility should be higher as price is trading lower. So if you take a contrarian approach and you say, okay, price is really screaming lower, but it's coming into an area that I think is going to provide some support to the market, then what you can say to yourself is, well, if price can sort of demonstrate to me that I'm getting enough of a bottom here that we're not still screaming down, well, you can sell it and volatility is still going to be relatively high. So as long as price sort of trades sideways or starts to come up, volatility on that underlying is going to come down. And so you just sold a lot of volatility that's going to drop right out of the premium. It makes it a little bit, in that sense, easier to sell the puts. You just have to know that you're doing it, or at least you never know. That's poor terminology on my part. You have to have a strong thesis that price is going to be done rocketing down, because if price just continues, then volatility is going to continue to expand. And now you have volatility and delta working against you. So after you've sold it to open, you buy to close. You buy to close when there's enough volatility and or theta to have decayed the credit value, and price has moved efficiently away from your short put, or you have reached your profit trigger. Sometimes, actually most of the time when I sell, if I'm selling for a lot of time, I'll just put a 50% profit trigger on. And so that means if I'm selling a lot of time, then all I'm trying to do is actually make 50% of the profits that's on that. So if I sold for $3, when it's only worth $1.50, I'll have a trigger on that just closes me out then. Because what I'm really trying to do with these short, long positions is make them nice and easy and sort of supplement my trading when I'm trying to do the weekly butterflies that have to be really, really sharp. We haven't yet talked about butterflies. We will, but just know that or at least my idea with these longer in time credit scenarios is we try to sell them at a time where the market is turning around. And then while it's not necessarily getting us a grand slam of credit, it should be a relatively easy trade to pull off. And it should be a reliable profit that should happen for us consistently. All right. And then you want to allow the short put to expire out of the money for the full credit. That's another way that you can do it. So if you don't put a profit trigger on, you can say, you know what, price is not going back up here in the time that I have allotted to it. So I'm just going to let it expire and collect the rest of the premium that's on it. Selling a put benefits from volatility drop. Obviously, it benefits from theta decay. It benefits from low delta or decreasing delta. And the risks are gamma exposure. The reason that I like to just go ahead and buy them back for 50% credit is because the closer we get to expiration, if price starts trading closer to me, all of a sudden gamma is really going to ramp up in my face, and it's going to be harder and harder for me to get out for the profit that I wanted. So I would rather close for 50% credit, reopen with more time and more space away. And now I'm not worried about gamma coming at me if all of a sudden we get a sharp move coming towards me. Another risk is volatility spike. And at this point, I'm actually going to, instead of using these slides, because they're just from earlier in our trading year, I'm going to jump back into the SPY slides or rather, I'm just going to jump into my Thinkorswim sim. All right. And so I was having, to be honest with you, I was having a little bit of trouble coming up with a strike price to just say, you know what, I would like to sell a put if we get here, because it's hard for me to say right now, but I am going to give you just sort of some ideas that I'm thinking about. Let's say, and again, I want to stress, I'm going to try not to be annoying here, but I'm going to stress that this is just a theoretical idea. Let's say that theoretically, for the sake of argument, this 348 is a secure low. I'm not saying it's a secure low, but let's say that it is. And let's say that we think price is going to come down to this 348. If price were to make it down to this 348, I have a strong opinion that volatility is going to be significantly higher than it is now. That's going to expand the value of our contracts, making it even easier to sell further away from the money. That will not be the only factor that I take to get into a trade. I would want to see, at least on the 15-minute chart, evidence that price is turning around. I'd want to understand my ticks. I'd want to understand a number of different technicals that made me think that at least for the day, we'd put in a bottom. Because I'm going to stop sharing for a second to talk a little bit more with my hands. If you think about it, if you're selling a lot of time and you think that a move has been made, but you're not necessarily certain that we're about to turn around, it's actually, as long as you feel like you're getting in at sort of the lower portion of the day, then you should be able to feel comfortable that, you know what, for today, I'm going to get a little boost in delta. Because if I'm selling around here and we've put in a bottom and we're starting to see some traction going higher, maybe we get more of a doji where price started way up here, price traded down here, put in a bit of a low, and now it's starting to come back up. Well, now I can get some delta cushion already on my side. I'm also, if that happens, I'm also counting on the idea that the next day, because price is evening itself out a little bit, volatility is being pulled out of the market. And so all of a sudden, the contract that I entered has lost a lot of its value. It lost value from delta. It also lost value from Vega because there's just less of it in the market. At this point, price can still continue lower as long as it doesn't scream down lower. So if price wants to work its way lower towards me, I still have a good chance of getting out in the next week, maybe 2 weeks, with a profit trigger. And so, wow. And then I can still take the rest of my mental capacity, the rest of my emotions, and put it through some more sharp trades, knowing that I'm sort of harvesting some theta and harvesting some Vega. So that's the idea and the framework that I want to work with. Okay. So jumping back into Thinkorswim, let's pretend that we do get conditions like that if price trades down here to 348. And now let's just sort of jump into the option chain to get an idea of what sort of premium we should be expecting. And I want to build this whole thing with the idea that we're going to turn it into an iron condor eventually. All right. So with that being said, rather than selling 20 days, because I'm going to leave that for a possible entrance on the call side, I'm going to sell 34 days. My idea here, I'm going to talk in my hands one more time. Apologies. My idea here is, for those that don't know, an iron condor is the same expiration where you're short a put and you're short a call. The beauty of an iron condor is you can take in twice the premium for essentially the same margin, because your broker knows that come day of expiration, only one side can possibly be wrong. If those strikes are far apart, it's impossible for your call and your put to expire in the money. It's impossible. So what we can try to do, if we're artful about it, is as we see the ebbs and flows of the market, we can try to get in on a longer term expiration with the idea of saying, you know what, if we get a bounce, if we trade up, well, now I can fade that bounce. I can sell against that bounce on the same expiration. And so I'm going to get into the option chain to kind of explain how to do that and try to be clear the whole time. So bear with me. Bouncing back to just the put side. All right, so that's this side of the option chain. And I got to go back to my chart. Right now we're trading right up here, 380. We're thinking about way down here. Do we get here? I don't know. Got to stop saying that. Sorry, people. The idea is to trade a delta that gives us theoretical odds of success. On the put side right now, notice, and we're going to compare this to the call side, notice the roughly 20 delta, a little bit more than 22 delta, is selling for $4.16. The 20 call is at 280. That's part of that, maybe because we're looking at this aftermarket, but there is what's called a skew generally to the put side. That's a pretty big skew. But what it means is, for the same probability of success, the market is actually going to pay you more money to sell on that side, because the understanding is that price, when it picks a direction to drop lower, is going to actually move. We expect price to move faster generally when it goes low than when it goes high. And so that's why you actually get paid a little bit more on the put side generally than the call side. But right now, that contract is trading at 355, current price 379. Let's round it to $25. So let's say we should expect a 34-day to expiration put to trade for at least $4.16 at the 20 delta, because we know it's going to get an added jolt of volatility as price is going lower. All right, so let's jump back to the chart. 348 minus 25 is 323. I hope I did that mental math correct. I'm not going to go into like going back in time for the purpose of today's call, because I think that would get cumbersome. But if I were taking this, if I were taking this trade live, I would. If I were taking this trade live, I would go back to see what does the chart look like back there. But for the purpose of this conversation, let's just put our strike down here. So roughly $323. The idea being that if price trades lower, we can sell. If price is down here 348 and we have reason to think that at least it's going to take a breather before it screams down even further, we can sell at 323. Now, let's talk about briefly, we're going to talk about how to turn that into a credit spread. All right. Now, for the purposes here, I can't demonstrate the 323 because now it's not worth enough money because it's too far away from current price. So we're still going to just focus on the 20 delta and make that sort of our fulcrum. All right. Right now, I'm telling Thinkorswim that I want to sell a naked put and receive the entire premium of $4.16. My account doesn't have the margin to do that. The risk on that trade is way too much for what my account can manage. But I can cap the margin by selling a call, or not selling, by buying a call further down the option chain. And so for me, and I encourage everyone who didn't see last week's call to especially watch last week's call to get the risk management portion. I'm not going to reteach the risk management portion, but it's extremely important. And I think it's really strong reasoning on there. So definitely watch for that if you haven't already seen it. For today, I'm going to assume that most people have seen that. I'm going to now shop in the option chain. And I'm not so much worried about like, oh, do I want to sell 5 points wide? Do I want to sell 10 points wide? That's not the way that I'm thinking about it. The way that I'm thinking about it is, how much capital do I have in my account to send to this trade? Because I am going to cut this off if it goes against me before I have to worry about the max loss. There is no way that I'm going to accept the max loss. I will close this trade responsibly before I get there. So instead, what I'm doing is shopping down this option chain to try to figure out, can I cap my margin at a discount? I would love to get it, super low and only pay like $27 to cap my margin. And now I'm collecting close to $4 on the trade. However, that is quite a bit of margin. So if you notice right now we're trading at we're hoping to sell at 355. For every dollar of the spread, that is $100 of margin that is going to be reserved. So that means we're looking at $500, $1,000, so on and so forth as we move down the chain. I think that I don't love it, but no, we'll keep it right here. I would have liked to get lower, but I think that, in between $2,000 and $3,000 of margin makes sense to set aside for something like this. I want to stress that I'm not saying that you should be thinking of it like you're risking $2,000 to $3,000. You should be thinking about it like you're risking twice the premium that they paid you to get into the trade. But with that in mind, let's just take it down to 330. So if I take it down to, whoops, what did I do? I did something wrong. And it's like my keys aren't working, people. There we go. Okay. So this is with the idea that I sell the 355, I buy the 325 to cap margin. I'm still collecting $3.26. All right. But importantly, and this is how we would turn it into an iron condor, or at least how we would start to think about the framework of an iron condor. Notice that right now we have a 30-point spread. I have, and so I'm going to bounce back to just my hands again. I have now $3,000 worth of margin that is free for me to sell on the call side. I can sell a 30-point spread on the call side that the broker is not going to charge me for at all, as long as I do it on the same expiration. If I don't do it on the same expiration, then the broker knows there's a theoretical chance that price could expire up here on one expiration, down here on another expiration. And so therefore, the broker has to reserve margin for both sides. However, because I'm going to keep it on the same side of the option chain, I can say, let me wait and let me see if I can get in at a better price. Now, back to the chart. A traditional iron condor, just a normal iron condor where you're not legging in, has the philosophy that
You're not showing the chart, Jay.
what's that?
You're not showing the chart. You wanted to show the chart?
Oh, you said I'm not on the chart?
We don't see it.
Oh, thank you. How about now?
Yep, you see it now.
Great, thank you. Traditional iron condor, you get in, sell the 20 delta on the call side, sell the 20 delta on the put side at the same exact time. You would do that if you have a very neutral outlook on where price is going. And if you have a great risk tolerance for price moving a little bit against you in one direction, a little bit against you in the other direction. This is the way, and I don't want to misquote her, but I'm pretty sure that over the last at least week and a half or so, this is the way that Suzanne has been trading. She's been trading really delta neutral strategies. So that means that price is moving in one direction. It's counteracted or rather price is hurting one side of her trade. It's counteracting by a similar delta on the other side of her trade. What I'm more interested in doing is legging in. And it's because my psychology is not yet as strong as Suzanne's yet. And so I want to always leave myself room for growth. But what I mean by that is I don't like to put on a trade and then have something surprising happen and have to just give it a little bit of time to fix and adjust itself. I'm pretty good at moving legs around and playing defense. I'm also not as good yet as Suzanne is. She's a better defender than I am. So because I know that emotionally that's hard for me, and because I know that I'm still honing my defensive skills, I would rather play defense when I enter the trade. So the idea is, rather than just say from any given place in the chart, I'm selling the 20 delta, the idea is to say, you know what? I'll sell the 20 delta on one side of the option chain when I think price is going to turn around, but I'll sell it for enough time that if I get some fluctuation, well, now I can sell sort of the other extreme of the option chain. And so sort of to drive that point home for today, I'd like to just look at what the 20 call looks like now. And I'm not saying that now is a great time to sell or anything. I was actually, just to be transparent with everybody, I felt like I missed an opportunity up here. I'm not going to get into all the reasons why, but I will tell you, it took me by surprise when we got this high yesterday morning. I thought there was a chance we'd do it in the afternoon. So when I stopped looking at the market to teach, I didn't set any alarms because I was like, this is going to be a pretty, maybe like a slow grind up. And so when I got back to the charts, I had kind of missed, in my opinion, I had missed the opportunity to sell there. But I digress. Let's look at turning this put idea into a call idea. Let's look at it on the iron condor side and then talk it through. Okay. So call side right now, the iron condor, you get 280 for selling the 20 delta. Oh, I'm sorry. I have to go back. And that puts you at 402. So the thesis behind selling that call side at 402, you're saying that this gap would be, you would see that gap as resistant. If price rockets up towards you, you would think, you know what? The first time that we visit this gap, I think that we'll see some resistance from the market. And I'm okay with seeing some red as price trades towards me, because I want to let price encounter that gap if it has to. I want to stress that that's not the only reason. You would also want to think in your mind, you know what, tomorrow we're going down. So last I looked, Amazon was recovering. Amazon like looked terrible right at earnings. It started to recover a little bit, still looks terrible. Apple looks pretty flat. So hard to say what tomorrow brings. But let's just get back into the iron condors idea, and then hopefully I can drive this home. Selling the 20 delta up here. And now remember, I have $3,000 worth of margin that I can work with. Unfortunately, selling the 402, I've got to sort of add a little bit. Nah, I won't. Yeah, yes, I will for the purpose. No, I won't. Sorry. We'll keep it to $3,000 margin by being a little bit tighter on the call side. So what I was arguing with myself about is 402 up to 425 is where we cut it off. Oh no, we can go 430. Sorry. So now just looking at this, we're 28, so we're $2,800 worth of margin on the call side. We're $3,000 worth of margin on the put side. And so what that means is, from a margin perspective, we're putting the calls on for free. The calls margin are already covered up by the put margin. The only thing that I would do different, and I'm not sure when to pause for questions, if I should pause now or no, I'm just going to power through and then I'll pause for questions. But the only point that I want to make different is, if I were taking this trade live, I would start it with the call side. I would be selling the calls 34 days till expiration, not the puts yet. But I would be doing it with the idea that, hey, if we trade lower and we start to see some support as we're chopping around in here, and it looks like we're putting in a bottom, it's at that time that I would leg in to my put side and have a much wider iron condor, where now I feel really comfortable on both sides. And I feel like I'm managing both the call side and the put side from a position of strength. And so I went through all of that. Hopefully if I lost anybody, we'll ask questions to clarify. But I went through all of that to try to, every week, we started sort of one leg at a time. And I just want everybody to be able to look at options as building blocks, as both time and delta building blocks, but also figuring out ways to capitalize in terms of volatility. So I'm going to take a moment, pause for questions, because I know that was a lot, and turn it over to the floor.
I have a question, Jay. What is your timing when you get into a trade like this? I mean, I know that you're not doing zero DTE, but are you typically waiting in the morning till after the, the 30 minutes of the market settling down? And then when you're legging in, you're looking for price movement, or just, that's my question, is about the timing of it.
Sure. Also, let me bring that one up on a 15-minute and sort of show you how I just wasn't able to do it. I will say that I have a lot of ideas for a lot of different types of trades. So I've sort of talked about this with both Ryan and Greg. Like, my biggest issue as a trader is I really like to be perfect, and it drives me crazy when I'm not. So this trade, like, maybe I was being like a little bit too much of a stickler. I'll say that, and I also just want to make it clear that my idea is to say, let's do trades like these to help supplement our sharper types of trades, right? But let me just jump into the 15-minute on SPY, sort of show you what I was looking at yesterday and just, why it didn't work out for me. So basically, I'm not able to watch the open to about when this candle starts printing is when I'm able to kind of start watching. And so I noticed we had this big move up, but I wasn't particularly bullish on the day. And so when I saw this consolidation, it was time for me to teach my next class. And when I saw it, in my imagination, I didn't see this happening right away. My imagination saw, like, I think that we've kind of put in the morning move. And so in my imagination, we were going to just sort of consolidate and then maybe in the PM reach up a little bit. So then when I got back into the charts and I looked and I saw like, oh gosh, remember 387. Let's just bring up SPX real fast. That is because SPY follows SPX. 3886 is really close. If you remember in the Telegram, Suzanne was highlighting, you know what? 3900 is resistant. So what I was hoping to do was get close to 3900 and sell against it. Not because I thought, and notice the way that she teaches those resistance, they're also magnets. And so it wasn't that I thought that 3900 would be like hard, rock solid resistance that we're not going to ever cross the line. But I did feel like, you know what, if we breach 3900, we'll get magnetically pulled back down. And so I was like, this wouldn't be a bad place to sell. So anyway, I'm watching the market, not in here because I'm teaching. I stopped teaching as this candle was finishing printing. No, it's a little bit later. I stopped teaching as this candle is printing. And at that time, what I was actually hoping for was just to get a little push back up here. Because what I didn't want just sort of draw a line here. Oh, I'm sorry. Let me put it on SPY. I thought somewhere in the 385 would be resistant for me. And I thought that it would be a place where I could sort of confirm that we were trading lower and still sell a 20 delta. Where if the next, not knowing what Apple was going to do for earnings, for example, today, feeling like, you know what, if price grinds higher, then at least I'm not selling more towards the low of today. And so as price grinds higher, it's still coming back up to where I sold, and I still have my little theta decay that's helping me. And so that's why I was still being sort of a stickler for that entrance. But if you think about it, as price is trading down here, 383, and I know it's a 20 delta that I was going to sell, so it's only 40 bucks. So it is largely psychological on my part, but it's who I am. I just gotta grow with who I am. I can't help it. However, this is also the way I was thinking about it. Oops. if I sell up here, I'm still selling sort of above the day before's close. And I feel like that's better location than selling sort of inside that body. Because, you know, I had no way of knowing at the time that we were going to have such a weak close on that candle. If we had more of just sort of like a regular doji body, there's a chance that Delta works against me. And then the next couple of days, price floats up. Delta's working against me more. And then I also had one other thing in my mind, which I do think is important to point out here. I am not a Bollinger Band expert, but as a seller of credit and premium, especially when you're thinking about iron condors, I do look at them. And for example, I was in an iron condor, like I have the memory of defending. Why won't this zoom for me? Oh, I gotta, no? Huh. Notice this sort of sharp incline on the upper Bollinger Band that sort of went on for a while. I have the memory of defending an iron condor here and doing a really cool job of it, but it was not fun. Even though I did it was cool the way I defended it and I didn't take a loss. I just don't like putting myself in these positions. So having this little data piece against me, in addition to just sort of seeing the way that this was trading, what I didn't want was to say like, oh gosh, we put in a high of the week. And then like, actually, no, we didn't put in a high of the week. We're ready to keep on running. And it's just annoying now. So that was a lot. I don't know. I don't know if that helps or just like muddies the waters more. So I'll stop.
Jay, we had another question on the YouTube channel from Juanita. She wants
Yes.
you could review why you chose the specific strikes on the call side.
Yep. Let me make that clear. All right, so the call side, 430 and 402.
You got to share your screen.
What? You guys, thank you. The most annoying presenter ever. Okay, here we go. 430 and 402. No. Oh, on the call side, sorry. I was thinking put side. The reason that I did that, or the reason that I presented that, is with the theoretical idea that we're putting in a high and we're ready to start coming down. So if we wanted to leg into an iron condor, if the idea is, hey, I want to sell on the call side as I think price is ready to decline, and then later on at a later expiration, so in other words, selling the call side with 34 days to expiration, maybe then a couple weeks later, this November 30th now only has, in between 25 and 20 days till expiration. Well, now I'm selling the put side there. And I'm just draining premium from both sides of the market. So the idea from selecting those strikes was saying, okay, maybe we're putting in a top, not saying that we are. Clearly, I want to emphasize this. I wasn't convinced enough to take the trade yesterday. So it's always just theoretical ideas. But that is the 402 call right now is our 20 delta when we look at 34 days from expiration.
Is it okay to ask a clarifying question or two? Maybe?
Absolutely. Yeah, absolutely.
So if I understand this correct, am I right in saying that I'm selling two verticals
Yes.
and two verticals sold together or sequentially. That's what we're calling an iron condor.
That is exact. And so an iron condor is two verticals on opposite sides of the option chain. So it's an iron condor is always going to be call side and put side.
Okay.
And it's always and it's not actually I'm not sure. Maybe I might misspeak here. So I'm gonna actually check in with Suzanne before I do and then put it there. For right now, let's keep that definition there.
So on the put side, is that a put credit spread,
Yes.
and on the call side is a call credit spread.
Yes. The
And
put
the reason that I'm doing this is I get one of the verticals for free from a deployment and capital perspective.
correct.
You got me feeling like a genius, man. Either that
You
or
got me feeling like I can
self-landed.
teach. I appreciate you. Now,
All right.
and I like the way that you worded it, because it, my paranoia, I always got to emphasize the extra side is free from a deployment of capital side. It's not free from risk.
Yeah. Yeah, no, of
I'm
course.
just saying that I know, I'm saying that, make sure we have that emphasized for the greater good.
So what you were amplifying as specific to what you call legging in, I think is the terminology used.
Yes, sir.
Okay. So that's more of a preference thing to say,
Yep.
okay, ultimately I'm going to go into the iron condor, but I want to see how this thing sets up a little more. So I need to boost my conviction before I just go all in. My question,
Right.
did I get that?
That's it. Let me emphasize it. If I know that we've been chopping around like crazy, that's what's been happening. We've been having these big moves that are then whipsawing in the other direction. Then two things can be true. I can sell an iron condor right now because right now just 20 delta, because I say, you know what? We're chopping around. We're going to keep chopping around. That's a strong trader. Suzanne is a great trader. She's a killer. She's doing that. She's doing things with that type of thesis. But also for me, and you see how I'm just like, I missed it by 15 minutes. And I'm just getting but whatever, that's me. I can also say, well, if we're chopping around so much, if we've been chopping like this for this long, well, let me sell up here. And then a little while later, when we chop down here, let me sell down there. I still am taking the theory of the iron condor. But now my wings are so much wider because I entered at different at different prices of the underlying on the same expiration.
So does the broker honor the free trade or the free vertical still? Or for you to get the free vertical, do you have to do it all at once?
The broker should honor that.
Okay.
And
Okay.
I will say, this is, I don't call Thinkorswim now as much as I did in the beginning. I used to have them on speed dial, like I was calling them all the time.
Yeah.
But I did have a conversation with someone, like the first level that answers the phone.
Yeah.
And that person did not understand this concept. So when I asked it first, they were like, oh no, that'll still take, it wasn't that I was in a trade. It was like, oh no, that'll still take twice as much capital. They were wrong. They just didn't know what they were talking about.
Okay.
So just know that if you hear something that doesn't make sense, you can just, the best practice to me is just, just politely say like, oh, can I talk to an options trader? Just like,
Yeah.
because you're not talking to an options trader right now. And then they'll put you on with somebody else.
Yeah, no, this really landed it for me because the multi-leg thing, I was never a fan of that stuff, but actually you've got it to where I understand it.
Great.
The light bulb just went off. So thank
Great.
you.
Absolutely. My pleasure. I'm glad. That was Regina, I'm really glad to see you, because the questions that you were asking last week, they kind of pushed me to come up with this point for this week in terms of legging, because Regina was just like, all right, like I'm in this trade for like a month and she's right. Like I see the pushback there. But when you start thinking about it, like, okay, maybe we're in a trade for an extended period of time. Maybe you have to wait for the right setup for this trade, but we have the potential to make it pretty easy on ourselves if we then add another leg on the other side on the same expiration. And now we're just draining the option chain from both sides.
That prompted another question, sorry.
No problem.
So is your exit approach still the same? Meaning, are you targeting that 50% profitability and you're out of there? Or are you riding this thing because you've now got all this protection? What's your move or approach?
I think there's a couple steps in nuance.
Okay.
So first, you sell your credit spread and you put that 50% trigger on. Because if you get a big drop the next day, you can forget about it. And you can just sort of like on to the next, right? Then, if you don't, then like say price is chopping around and you're like, you know what? Price, you're convinced, because we don't have to get way down to the bottom of the chart before you're convinced that, you know what, it might be a good idea to sell a put spread on this expiration. That can happen. And you can say, we're definitely not going up to my calls way up there. And we're not going to continue down to these puts. So I'm going to take my 50% trigger off for now. And I'm just going to drain the condor. And maybe I'll put my 50% trigger on my puts now, which still has a lot of premium. And now I'm just getting some extra juice out of my calls that I wouldn't have. So I think that I do think that it's important to be situational and to be nuanced there. And then to just decide, like, you can always just think about it. And what I don't think you should necessarily, with a strategy like this, get stuck into doing is saying like, well, now I'm going to like roll my expiration over on one side and not the other, because now I'm really draining my margin.
Okay.
I would really just think of it from a margin standpoint and like, all right, I'm setting this margin aside. I don't think that I'm threatened. I still have premium that I can just be patient and it's going to give it to me while I'm trying to make these other tight weaving maneuvers in and out of this chop. And I think the benefit of that is, while I've been weaving in and out of this chop, sometimes I'm doing a great job and sometimes I'm getting hit in the face. And so, I'm okay with that, because with the weaving, I'm still keeping risk in check. But if I had a few more extra like easy strategies on, then that would help my P&L. Instead of like chopping like this, it'd just help it smooth out a little bit.
Yeah.
That's why I'm looking into these like not only butterflies type of ideas.
So the trade management side of this, how much hands-on? Because it sounds like you missed a couple of key points, and I know that you strive for perfection and things like that. But how would you say is the trade management? Is this a set it and forget it sort of, or is this like you need to be glued in 15 minutes and be ready to move to play with legs?
I think in this market, on your entrance, you need to be good.
Okay,
You don't want to get an entrance and then price is screaming against you, because we're so volatile right now
yeah,
that now you're gonna, if price is screaming against your entrance, and then the next 3 or 4 days price is still screaming against your entrance, and then this was your first trade trying to do credits, like that's just a lot. Like I wouldn't want that for anybody. I'd rather do this in sim, but try to get it tight. Like try to get it to a place where, you know what, an hour after you get in, price is backing off the way that you thought it would, or at least price is flat the way that you thought it would. Once you're in sort of with these credit ideas, once you're in the trade for a day or two, 3 or 4 days, the management, as long as you got your entrance good, your management should get easier and easier, because time is eating away at the delta. Theta is killing your delta. Theta is eating away at your premium. And so but you should, I think we should always be aware of what's going on. And then we can start to set nuanced alerts.
Okay.
At first we got to keep those alerts pretty tight. And
Yeah.
then as time fades away, well, now it's going to take a bigger and bigger move to really do any damage to you.
cool. Thank you.
Absolutely.
Hey, Jay.
Hey,
So, I'm enjoying the conversation and everything, and the strategy you put forth is very good, very interesting. Scenario that I'd like to discuss is, let's just say you got into the call credit spread, the time when yesterday at that high right there.
yes, sir.
And then let's say, you got a good, good credit for that. And obviously we're looking into the future now. So today, the market went down, so you feel good about that credit spread, that call credit spread. But let's just say we kind of meander down, not really, no sharp line down, but just like a slow grind down. How deep? So if you're putting that credit spread and you're going 34 days out, when
Yes.
when is it too late to put on the put side of that? So like after, if you're in that credit spread and there's say 14 days left and you haven't put on the put side yet, would you even bother to? Because now you're talking about.
Yeah, that's a good one. I probably wouldn't, because I think let's just look at it. And also for argument's sake, I was looking at selling a spread for 290, and that joker is trading for $1.43 right now. But because I had it saved. Let's look at 15 days out, what you would hope to get on that put side. This is what I think. I bet you when Suzanne sees this, she's going to have notes for this idea. Just so you guys know, she's going to have ways to make this a little bit tighter, which is great. But no, you'd still be getting up. You know what, man? Maybe, right? You're still getting 310. And then
my thought wasn't so much the credit, because you'll still get a good credit, but
yeah,
the gamma, once you get inside 14 days on that credit spread.
Well, let's see how far away you are, because it'll be a little closer. 377, 360. You know what? No, I wouldn't. And like, look at, I think that what we're seeing is, the nice thing about this strategy is you maybe don't need to be as, insane as I would. I don't want to say that, because if price rockets against you, it's annoying. I know that. But All you need is, it's not like today we rocketed down. We got a little bit of a push down and we're fine. I don't think that I would bother. You know what I do? Thank you, because that's a good push. What I would do is I would probably just start my cycle over again. So I might have not really got my profit all the way drained on the call side. I just close that out, sell more time on the put side, and just be ready to start over again.
Okay.
Because I just don't think it makes sense to say like, oh, well, let me just sell another credit spread and take up twice as much margin. I just don't think it's a good use of margin to like overspend on that, especially when it's, that it's going to be tied up for, possibly a couple weeks.
Right. So the other thing would be, in a way, you kind of needed to rock it down so that you kind of feel like you have a nice spread between the call side and the put side, so that you get in with a decent amount of time left, if you're thinking about it that way.
Right. No, that was a good push. Appreciate it.
Yeah, that's pretty much it. That was the thing I was kind of interested in, how you thought about that.
Yeah.
I have a question.
Yes, ma'am.
Why did you, and I don't know if I missed it, why did you settle on 36 days to expiration? Why did you?
Oh, yeah. And so, yeah, I'm sorry, I cut you off. Continue.
No. Was it the implied move? I was just wondering what made you do the 36 days to expiration.
What my idea was, and this really dovetails with the idea that Ryan's talking about, but I didn't make this clear. When you hit like in between 30 and 20 days out, that's when theta starts to really ramp up. And so it's 30 to 20 days is a time when you can sell pretty relatively comfortably far away from current price. And there's still enough theta in it, but the theta decay is going to start ramping up faster and faster. And so it just gives you that extra theta burn. The reason that I wanted to go like a little bit of a cushion, 34 days, is because say I sell it and price moves against me for a day or two, slowly, price chops against me for a day or two. Well, I want to eventually be able to sell on the put side. So it's the idea that I need price to kind of move away from my position, get a little lower, expand to the downside. And now I still have value in my calls, and it's worth it for me to now sell puts against those calls and still have the margin on both sides. Does that make sense?
Yes, it does.
Cool.
And my other question, I was used to doing iron condors, when something is channeling. So I would always kind of like do it in the middle of the quote unquote channel, or whatever the price is, I believe was at the top or on the bottom. Would that 36 days to expiration be the same, or really it would be less, since I'm thinking you're at the halfway point? So you're either going up or down. So I was just wondering, I understand the legging in. I just never thought of it because I do them, but is the same expiration, would it be the same if you do it in the middle as opposed to doing it like at the entry? I understand either the put side or the call side. So I was just wondering about that.
Yeah, for sure. When I used to like to do them, I like to do them 30 days out. And when I would just jump in, I would jump in 30 days out immediately when the market opened. because I wanted to sell volatility. And with the idea that, you know, you kind of know, well, if we have a slightly bearish day, then I'm going to be a little bit better. I'm going to be a little bit in the green. But also, if I sell that volatility and we have a little bit of a bullish day, some of that volatility is going to drain, and I'm going to have a bit of an advantage. And so then with those 30 days, normally I would be in them for about 10 days before I hit a 50% profit trigger. And so one side or the other was just going to decay a lot in those 10 days. And I would just put a 50% profit trigger when I did that. But I think that that's a good amount of time. There are situations though that are kind of interesting. Wait. I'm going to change it to a different scenario, but I want to tell you about it. But before I do, I want to see, do you have anything on what I just said there? Any questions or pushes?
No, I like to sell volatility also. So I get what you're saying on that, but I was just because I know it would be in a lot of ways, aside from the volatility and selling more time, it would be a larger credit. So I understand that, but the 30 days, and I always forget about that, getting down to 14 days about the gamma. So thank you. This was very good. Thank you. Thank you.
For sure. Here's another idea to play with. You wouldn't do this in the middle of a channel. You would do this with more of a bullish thesis. But say there's just another strategy for selling iron condors, where if price is like really tanking, but you feel like, you know what, we hit a bottom, then you can sell much further expirations. Like you can sell like 75 days to expiration, because the vega on those further out contracts is going to be much higher. So what your thesis is, it's like, okay, price just rocketed down. We should have a volatility crush. And so I'm just going to sell super far away, super wide, long out, like 75 days out. Well, now the next day when that volatility goes away, you have a great chance of hitting a profit trigger. That's just another thing that if you like entering them like that, you can play around with. So like, mess with that on demand and just sort of see how that works. And also you can just go in the chain and see how the volatility is bigger on the further out expirations.
Okay, that's good. I'll try that. Thank you.
For sure. For those who are not used to my wait time, this is my awkward wait time for anyone who has questions. And I'm gonna do a little bit of filibuster. It's always Carla. It's always it's Ryan. Thanks a lot for being here. Greg, thanks a lot. Regina, Vicky, thank you for the awesome questions and pushes and helping me to think. I really appreciate all of you. I also just want to extend so that anybody who's new and feels like this conversation. Oh, Carla, I'm sorry. What's your question? I bet you Carla's typing right now. So I'll just keep filibustering until the question comes in. Anybody who's new, don't feel like just because we're talking about something that feels a little bit advanced, like we shouldn't go back and talk about something that's more fitting where your question is. So just know and understand that. All right. You mentioned seeing Bollinger Bands expand and playing defense. Whew, what did I do? I'll give you an idea of what I did in the option chain. And if I was journaling religiously, like I am now, I'd be able to open up my journal and tell you exactly what I did, but I wasn't at that time, so I feel embarrassed. Basically what I did was I looked at the chain. And so we're just going to go super hypothetical. Price was working against me. And my call side was being threatened. So I was getting close to being breached, which means that instead of having like a 20, remember, if you sell a 20 delta and price is moving up towards you, then that 20 delta is, for every dollar, it's taking 20 cents and adding it to the cost of your contract that you sold, making it more expensive, causing your account to go down theoretically. Because I say theoretically because you haven't closed the trade yet. So as it gets closer and closer to current price, notice that what was once a 20 delta is now more like a 34 delta, 40 delta, oh my goodness, 50 delta. And so what I did was I actually bought a couple of call strikes, because my idea was, I really just don't exactly remember this trade, but my idea was we had broken some resistance that I saw, and I thought that we were going to move higher, but I wasn't sure. And so I do remember, this is one thing that I felt really cool about at the time. I remember telling Suzanne, first of all, I didn't ask her for help during it, which was a first for me, but she knew I was in trouble because she knew the type of trades I was doing. So she just sort of had reached out to me and say, like, you know, how's your iron condor doing? But I was like, hey, this is how I'm managing it. And at one point, I just bought a number of calls to put the deltas back in my favor. So I said, you know what, right now I have 50 deltas going against me. I think we still have this move going forward. I can watch it for the next couple of hours. So because I felt like, you know what, we're going to be bullish, I bought enough calls to put 200 deltas in my favor. And so now that I only needed price to move a little bit up to kind of recapture my losses, because as price continued to go higher, if I had 200 deltas in my favor but 50 deltas not in my favor, then what I really am looking at is 150 deltas in my favor. And so I let price sort of trade up until break even. It was a super choppy trade. I do remember this. And I remember looking at my balance at the end of the day and feeling like I dodged the bullet, and then looking like, ooh, I've got these deltas. If we push up tomorrow, I'm really going to be good. And I almost left them on. And then the next day we tanked. So luckily I closed the whole thing. And really what I did with that trade was actually, rather than taking a loss, I broke even. There's a chance that with us really backing off the next day, had I not done anything at all and just sort of looked at it, stared it down the whole time, that the trade would have been okay. But what I was able to do was buy some calls, put some deltas in my favor, and then just feel happy that the trade didn't damage my account in any way. That's for various traders. That's like, there's some traders that is just super, super normal. Did I not share my screen again? But anyway, sorry.
No, you didn't. But
I was like looking at it in the chain. So sorry, it's over now. You were gonna tell me that.
I thought you were just explaining it that way.
But that's one of the ways that you can do it. Another thing that I did in that trade was I actually rolled my put side up. So what that means is, because calls were being threatened, I wasn't getting any credit out of my puts. So I just sold some puts that were higher up. So, and essentially the idea behind that is, price has traded so far away from your puts that what was once a 20 delta on your put side is now like a 4 delta. on your put side. Well, that's not going to help you a whole lot anymore. There's not much juice left in that contract. So rolled up, sold the 20 again, which is now closer to current price. And as price continued to move away, well, now that gave me like another little cushion. But at the end of that trading day, I collapsed the whole thing. For people who can watch the market all day long, playing defense is really cool. For me, like, it's really tacky to be teaching kids and then like on my music stand, there's a laptop and I'm like watching the market and like trying to figure out, like, I just don't like doing that. I don't. They're like, you know, there's some days where I have to do it. They're rare, but I have to do it and my classes move along just fine. I'm not as good of a teacher on those days. Kids roll with it because I do it super seldomly. But if I'm putting myself in that position all the time, then my relationship with the kids that I teach, which is just on a human level important to me, that's going to go south. My self-worth is not going to be what it is now. And guess what? I'm going to be a worse trader because I'm going to have more negativity in my mind that's going to affect the way that I trade. So all of those things sort of go into a confluence that say, like, that's kind of why I'm super careful and super tight with where I get in, because even though it is fun. And then, you know, like, I get to tell Ryan, like, hey, this is how I play defense. He's like, yeah, you did it. You know, it's like, and we get to like kind of pat each other on the back, but it's just like, it's good to know that you can do it and to understand the ideas, but it's even better to try to set yourself up where you don't have to do it.
Hey Jay, just to follow on that too. This might be a personal thing for you, not sure, but so when these, say you enter one of these spreads and it starts immediately, your thesis was wrong, goes against you. When do you cut it? Because, you know, with these spreads, it can get hairy real quick.
Well, the nice thing about the 20 delta is you got time. You know what I mean? You got time.
Right.
So that's the first thing, is that, you know, when we're doing the 0 DTE, you know, you don't have time. You're just like,
Right, yeah,
thesis was
right.
wrong. Or
Right.
or you're just like, thesis wasn't good enough. You know,
Right.
it could be right, but it wasn't good enough. Get out. You know, when you're 20 delta 30 days out, you do have time. You're on SPY. It's not, you know, it's not going to kill you in a day. The way that I was looking at it was to do it from a pure probability standpoint, which is 80% of the time that 20 delta should expire in your favor. So 80% of the time we're keeping those profits. Do that calculation, add it up. And this is, I wish I had it in my notes because it's in the last presentation, but I'll just sort of give you the Cliff Notes ideas. If price goes against, here's what I came up with by calculating. If price goes against you, like basically doubles the premium that you wanted to take, now you're paying that to close it. If price doubles the premium that you wanted to take and you're paying that to close it, over the course of 10 trades, if that happens twice, you're still highly profitable on this trade type. You know, on the scale of contracts that we were looking at, you're up $1,000 on the, you know, on that scale, you know, assuming that you're only putting on one contract, right? Now, for me, I'm still like, all right, well, that's fine. But we also know that it's just probabilities. Like, just because it's the 20 delta, you could still have 10 trades go against you. Like, there's no rule that says, and I'm not saying this to you specifically, I'm just sort of like making this point. There's no rule that just because you sold the 20 delta every like 10 times, automatically you get those odds. You know, if price is rocketing up or whatever, like it won't. Do I think it's likely that you get much worse odds? I don't really, but it's just who I am, that I'm still like, I still want good placement, because I did have it up in my mind that if I entered that trade, I was not exiting it unless I was really proven wrong. So, you know what I mean? So it's like, if I really want to take that type of feeling on, then you know, then I got to feel good about the entrance.
But yeah, that's where the put side comes into play too, because if you, well, you have time on the call side. If you were to get in on that side, you know, let it play out. And then if you do get it to go in, you know, the way you want it to, then once you put in the put side, now you have the iron condor. So only one side could be wrong. So that helps with your odds too. Right,
exactly. Right. Which is also why you don't want to get in on your first leg wrong, and now you don't get to the, you know what I mean? Yeah.
Get to the other side of it, right?
Yeah, you're playing the put side from behind the 8 ball in that scenario.
Right.
Like, yeah.
When you were playing defense, how did you choose your strike for your calls? Just curious, what delta did you use? Did you use like, well, if it was available, a weekly expiration, since you probably maybe knew you were just going to be in? So just curious about that.
At that time, I went in on the same expiration that my contract was on. I did the same expiration, and I went delta shopping, because what I wanted 200 deltas. That's what I wanted. But you know what? Now that I'm remembering more about this trade, what got me the 200 deltas was a combination of selling my put. So selling that put gave me 20 deltas. When I sold the put, I left on that side, I left the long put where it was. So the long put was like not helping at all. It was way off, completely worthless. But I was like, I'm not rolling that side up. So I just rolled that put side up, and I knew that I had all of its 20 deltas in my favor, because I wasn't paying the long side delta at the same time. So now from the call side, I needed 180 deltas. I don't remember if I bought 3 at the 60 or how I got there. I don't, but I just know I was like, okay, I think we have this much more move. And if I can, because we're doing this much move, I think before there's resistance, then I need this much delta to help me out. And so that was sort of the way that I thought about it.
Okay, understood. Thank you.
For sure. All right, at this time, please cut me off. If you have an extra question, please reach out to me in Telegram. I'm always super happy to answer questions. Also, feel comfortable to add to the conversation to Telegram. That goes for everybody. So I don't want you to feel, you know, if you're new and you have a question, by all means, ask it here. If it doesn't come to you now, ask it in the Telegram group. You can also, if you don't feel comfortable asking in the group, you can ask me. But honestly, everybody that if you're new, for sure, like everybody that you just saw talk, between Ryan, Regina, like Vicky, like reach out to Vicky. All of us are super happy to answer questions. Great traders up here on the panel asking questions. It's like they all kept me on my toes. It was really cool. Everybody knows that Ryan is my arch nemesis. he's always getting better fills than me. He's always coming for me. Go ahead, Ryan.
That's so not true, but I'll let you tell it that way. That's all right.
But just want everybody to know that same way that we started the call, this community cares about people that we don't know. So we definitely care about our community. So by all means, please make sure to ask questions. Had a great time with you guys as always. Thank you to everybody who showed up. And so to everybody, just have a great night.
Thank you.